Welcome back. I want you to think back to just a few years ago. Do you remember a time when the first Tuesday of the month was just a Tuesday? Back then, nobody really cared about the Reserve Bank of Australia. The letters RBA weren't trending on Twitter, and your cab driver wasn't giving you hot takes on monetary policy. But today, it's a total circus. We see it across every social media platform. Everyone is glued to their screens, waiting for the smoke to clear. Will they hike? Will they cut? Will they hold? It feels like the entire nation holds its breath to see if their mortgage repayment is going up by $50. And look, I get it. If you have a massive mortgage on your own home and money is tight, that interest rate number is scary. It affects when you can enter the market and what you eat for dinner. But today, I'm going to tell you something that might sound completely insane. I'm going to tell you something that goes against every headline you read in the Financial Review or see on the nightly news. If you're a serious property investor, someone with a goal of building a multi-property portfolio, interest rates simply do not matter. In fact, prioritizing a low interest rate is often the single biggest mistake that stops investors from getting past property number 2. Today, we're going to explore the real engine room of property finance. We're going to discuss the 3 hidden levers that are infinitely more powerful than the interest rate. So, turn off the news, put down the calculator, and let's get into the mindset of the elite investor. The opportunity cost of cheap money. Before we dive into the specific factors, we need to address the elephant in the room. Why do I say rates don't matter? If you're just buying one home to live in, sure, shop around. Save that 0.1%. But if you're building a business of buying houses, you need to look at opportunity cost. Let's say you find a bank offering a rock bottom rate. It looks great on paper, but that bank is conservative, slow, and rigid. Because you insisted on using them, you miss out on a high-growth asset. If that property grows by $100,000 in 2 years, and you missed it because you were trying to save $2,000 in interest, you haven't saved money. You've lost $98,000. This brings us to the first factor that trumps interest rates every single time: velocity. Specifically, the speed of approval. Factor 1, the need for speed. Imagine this scenario. You have done your homework. You've researched the suburb, you know the streets, and you've done your due diligence. You are ready to pull the trigger. Suddenly, an opportunity drops in your lap. Maybe a selling agent you've built a relationship with calls you up. They have a vendor who needs to sell now. Maybe it's a divorce settlement. Maybe they bought elsewhere and need the cash. The agent tells you, look, if you can give me a signed contract with unconditional finance approval in 7 days, the property is yours for $850,000. If not, we launch it to the open market next week, and it'll probably go to auction for $950,000. This is where the game is won or lost. You go to your low-rate bank. Let's call them Bank Snail. Bank Snail has a great rate, maybe 0.2% or even 0.5% lower than the competition. You submit your application, but Bank Snail is backed up. Their processing team is offshore. They ask for a document, you send it, and they take 48 hours to look at it. They tell you, sorry, from application to valuation to formal approval, we need 2 to 3 weeks. Guess what happens? You lose the deal. The agent can't wait. They put on the market. A bidding war starts. The price goes up. You just missed out on instant equity and a prime asset because you were chasing a rate discount. Now, contrast that with Bank Speedy. Bank Speedy is a bit more expensive. Their rate is 0.5% higher. But your broker tells you, these guys are hungry. We can get a valuation ordered today and formal approval in 48 hours. Which bank do you choose? In my view, you choose Bank Speedy every single time without hesitation. Why? Because the cost of a slightly higher rate is peanuts compared to the cost of missing the deal. Furthermore, if Bank Snail is too slow, you might even miss your settlement date and get hit with penalty interest or legal action from the vendor. And here's the kicker. Folks, you are not married to your mortgage. Use the fast bank to secure the asset. Lock it down. Then in 12 or 18 months, when the dust settles, refinance to a cheaper lender. But you can only refinance a property you actually own. You can't refinance a missed opportunity. So, factor number 1, speed equals equity. Factor 2, the valuation game. Now, let's move to the second factor, which I believe is the silent killer of property portfolios. It's something most rookie investors don't even think about until it's too late. The bank valuation. We tend to think that a house has a specific price. If you pay $1 million for it, it's worth $1 million, right? Wrong. To a bank, it's worth whatever their risk manager says it's worth. And the variance between banks can be shocking. Let's run the numbers. You're looking to buy an investment property for $1 million. Bank A offers you a slightly higher interest rate, but they order a valuation and it comes back at the full purchase price, $1 million. Great. You put down your 20% deposit and you're good to go. Bank B has that super low honeymoon rate you saw on a billboard, but their valuer is conservative. They look at the market and say, we think this is only worth $900,000. This is a disaster. If the bank only lends 80% against $900,000, they're lending you $720,000. But you agreed to pay $1 million. Suddenly, you need to find an extra $80,000 in cash to cover the shortfall. If you're a typical investor with limited capital, that deal is dead. You can't complete the purchase. All because you picked the bank with a better rate but the worse valuation. This becomes even more critical when you are playing the equity release game. The secret to building a portfolio of 3, 4, or 5 properties is using the equity in your existing homes to pay for the deposit on the next one. If you go with a conservative bank that undervalues your current portfolio, they're essentially locking up your money. They are trapping your equity in jail. Some banks require a full human valuation where a guy walks through with a clipboard looking for cracks in the wall. Other banks use desktop valuations or automated system models that might be more generous or faster. Your goal is to find a bank that gives you the access to your money. If a bank allows you to pull out enough equity to buy another asset that is worth infinitely more than saving $50 a month on interest payments, the bank that helps you buy the next property and the one after that is the best bank. Factor 3. Policy is power, the serviceability wall. All right, we've covered speed and valuations. Now I need to talk about the boring stuff that is actually the most exciting stuff, credit policy. This is where the rubber meets the road. This is how the bank decides if you can afford the loan. You might have heard the term borrowing capacity or serviceability. Every investor eventually hits a serviceability wall. The moment the bank says, sorry, you earn enough money, but our calculator says you can't afford any more debt. But here is the secret. Every bank uses a different calculator. The difference between a Big 4 bank and a specialized Tier 2 or Tier 3 lender can be hundreds of thousands of dollars in borrowing power. I had a client recently. Let's call him David. David already owned 5 properties. He was a serious player. He wanted to buy number 6. He went to a major bank, one of the big household names. They ran his numbers and said, David, we can lend you $300,000. Now in Sydney or Melbourne, $300,000 gets you a car space, maybe. He was stuck. He thought his investing journey was over. But then he went to a specialist broker who knew the policies of different lenders. The broker took him to a Tier 3 lender, a non-bank lender. This lender looked at the exact same income and the exact same debts, but their calculator was different. They offered him $1.1 million, an extra $800,000 in borrowing power. How is that possible? It comes down to policy friendliness. Here are the questions you need to ask, rather than what is the rate. How do you view my income? If you're a frantic corporate worker, you might get huge bonuses or commissions. Some banks heavily discount that income or ignore it entirely because it's unsure. Other banks take 100% of it. If you work overtime, does the bank count it? How do you view rental income? When you buy an investment property, it generates rent. Most banks shade this rent. They only count 80% of it to account for maintenance and vacancies. But some aggressive lenders might count 90% or treat it more favorably. That boosts your borrowing power significantly. Self-employed versus PYG. If you run your own business, some banks treat you like a pariah. They want 2 years of tax returns and they average out your income. Others look at just your last year, or they use add-backs to increase your serviceable income. And then there are the product features. For an investor, cash flow is king. You might want an interest-only loan. This keeps your monthly repayments low, allowing you to weather storms or save for the next deposit. Bank might say, we only give interest-only loans for 1 year, and the rate is high. Bank B might say, we will give you 5 years interest only, and we are happy to extend it. Even if Bank B has a higher headline rate, the cash flow benefit of being on interest only might make your portfolio sustainable, whereas Bank A would bankrupt you with high principal and interest repayments. Do they offer an offset account, or just a redraw facility? Serious investors know that an offset account is crucial for tax separation and flexibility. If a bank doesn't offer a proper offset, I don't care how low their rate is, they're usually off my list. The strategic framework. So let's zoom out. We have discussed speed. We have discussed valuations. We have discussed policy. What does this all mean for you? It means you need to stop acting like a consumer and start acting like a CEO. A consumer looks for the cheapest price tag. A CEO looks for the best financing partner to grow the business. When you're building a portfolio, you're essentially playing a game of leapfrog. You buy property A, wait for growth, pull equity, buy property B. To do this, you need a lender that supports the next step. Maybe for property number 1, you use a major bank because it's easy. For property number 2, you use a lender with great valuation policies to maximize equity release. For property number 3, you use a lender that accepts 100% of your overtime income because your serviceability is getting tight. For property number 4, you use a non-bank lender with higher rates but massive borrowing capacity. If you had stuck with that first bank, the one with the lowest rate, you would have stopped at property number 1. You would have hit the serviceability wall or the valuation wall, and your journey would be over. My experience has taught me one undeniable truth. The rate is irrelevant if you can't get the loan. If a bank charges you 7% but lends you the money to buy an asset that grows at 10%, you are winning. If a bank charges 5% but says no, you are stagnant. I would rather pay a higher interest rate to a bank that allows me to expand my portfolio than get a cheap rate from a bank that tells me no more. And remember, you can always refinance. Lenders are tools. Use the right tool for the job. If a lender is fast but expensive, use them to secure the deal, then move to a cheaper lender later. So, the next time you see a headline about the RBA meeting where your mate at the pub starts complaining about how interest rates are killing the market, just smile. You know better. You know that while the amateurs are obsessing over a 0.25% hike, the professionals are looking for speed, generous valuations, and friendly policies. Find a broker who understands investment strategy, not just one who knows how to read a rate sheet. Find a bank that fits your long-term financial framework. That is how you win the game of property. If you found this episode valuable, share it with an investor friend who is stuck on the sidelines waiting for rates to drop. You might just change their life. Catch you in the next episode.